if anybody's attended a call that I've had before, it's a really different product. It's difficult to understand. There are a whole bunch of things about it. And what I thought I would do is I would kind of spend a little bit of time, talking about the landscape of where we are. In fact, let me do this. Apologies, I just want to share my screen if I can find that option. Share. Can you see that?
Here we go.
Can everybody see that?
We can. Thanks so much.
Okay, so I just wanted to take us through kind of a little bit of the economic landscape and where we are. A little bit about the rights action that happened mostly in Natal and obviously in Gauteng last month, and just what does that mean to trade credit insurance, and then I just want to talk about kind of understanding the risk of trading on credit. People, and I say people, obviously it's a generalist approach, but it's not often understood what trading on credit actually means, and I think that's quite important because if you don't fully understand what it means, it can create some unforeseen problems. Trading on credit is the easiest way to increase your revenue, which I think I've said before, because that means that you can sell to somebody and they can try and sell it before they have to pay you, right? So that's the benefit of the person buying on credit. But the pitfalls of selling on credit are a little bit different. I then just wanted to go into a little bit about fraudulent businesses. Fraudulent businesses come in a myriad of shapes and forms. There are two really relevant ones for the trade credit space, and I just wanted to talk through those as well and explain the different approaches that trade credit insurance has, or how the policy responds to those two different types of fraudulent businesses. And then I just wanted you to take you on a journey of what we look at when assessing a risk. Okay, the factors to look at, the questions that come out of that. What do we do to assess, the business? So this is not a trade credit 101. This is really about just applying our minds to what we do, and just want you to see how we think about things, so that we can get to a space where our clients, also in other words, our policyholders and our brokers, understand how we make our decisions. I think that's quite important for us. And one of the reasons why that is because a lot of clients and a lot of brokers, if we decline the opportunity, have a feeling that, oh, well, Hollard's declined the opportunity. They don't, well, not Hollard necessarily, the trade credit insurer has declined the opportunity. And now I can't sell to this client, which means I'm not able to earn sales, which means that trade credit insurance is actually, robbing my business of sales. Does that make sense? It's a bit of a layman's approach, but that's me. I'm a bit of a simple fellow, and I think it's important to just understand that there's a big difference between going on risk and ensuring a trade credit transaction that is not worth it, and one that is actually worth it, right? Because if we don't go on risk, what could happen is you sold to that client and they are unable to pay. Well, now you're out of pocket, right? You've sold a whole bunch of goods for nothing, effectively. So you've lost the money that it cost you to procure those goods. Okay, so trade credit insurance declining an opportunity is not always a bad thing. I think that's quite important. But what is crucial for me is that everybody understands the whys, right? So why did we make that decision? And the why or how we made that decision often goes back to what we looked at in order to assess the risk. I think that makes a hell of a lot of sense. I unfortunately can't see the chat section on this Teams thing. So, Mums, if you don't mind, just whenever there's a question, if you can just stop that.
Will do. I'll be your eyes and ears.
Okay, brilliant. But I have set this chat up, or this presentation up, to either allow more time at the end for questions, or allow free time for you guys to get on with your work. But I'm hoping to not take up all the time, because I think it's far more valuable to give you the tools to give everybody on this call the confidence to have the conversation about trade credit insurance. That's probably more important for me. Okay, so I hope that helps for now. Okay. The economic landscape in South Africa. I mean, this is just a summary of where we are, and certainly a summary of where we've been since we launched in 2016. You know, the country's been exposed to 3 sovereign downgrades. Obviously, the contraction in the economy. So we went down 6.4%. Okay, was the contraction in the gross domestic product, the GDP of the country, during the second quarter last year. And the terrifying thing is that was after they rebased the GDP. So a rebasing of a GDP is just every 5 years. South Africa goes through a process where we reassess the calculation. All economies do this in the world, and we reassess the measurements that we use in order to create that basket of goods that ultimately defines the GDP and inflation. And after the rebasing of that, we still were down 6.4%. Okay, we were down, I think, about 7.2% before the rebasing. So the rebasing was good for the South African economy. It made us realize that we weren't too bad. But obviously, it's a hell of a negative space to come back from. There's obviously a lot of a lack of confidence in the South African economy at the moment. There's fears about power generation and sustainable power generation. There's fears in the almost the value of the rand. There's fears in how we're going to recover COVID. There's fears, in the unemployment, and obviously all those fears create a bit of a lack of confidence in the country, and it makes it quite a difficult space to be. Right, unemployment are at record highs, and from articles that I've read, depending on how you slice it, we're the most unemployed country in the world now. That obviously doesn't bode well, and I've got a few other kind of conversations about unemployment and about entrepreneurship, which I can obviously address if anyone's interested after this. But it's just about looking at the world, and the next kind of really important positive/negative is that the low interest rates will not last forever. I think that's really important to understand. The interest rates were slashed last year to assist call it the purchasing power parity, or the individual spending power in South Africa, to try and accommodate the loss or that business contraction that happened last year. But those interest rates are not going to last forever. So what's important is that we don't create a living requirement, especially if the interest rate decrease helped you have more money to spend, right? Does that make sense? So it didn't help you survive. It created a different lifestyle. And what's important is that, that obviously that lifestyle is going to come to an end. Certainly from the indicators that I've read and the economists that I've spoken to, some of them are saying that we may still get a rate hike this year, in the last quarter of this year, and then some of them have said that it probably is going to remain stable for the next 1 to 2 years max. Okay, so again, anybody knows, right? It's either going to go up now or it's going to go up later, but it certainly is going to go up. And at the end of the day, that's a good thing. It's the beginning of the reform of the economy. So it's not all bad stuff when the interest rate goes up. That's the negatives. And the positive here, and this is quite important to me, I'd like to have a positive. You see that quarter two, obviously it's the 17%, because that was just that quarter. Obviously the 6.4% was across the year last year. But you can see that we bounced back quite nicely in the third quarter. That was obviously one, driven by the fact that the economy opened up again to a degree, and then secondly, about the rebasing of the GDP. So that's what caused that big spike for 13.9%. But you can see that we've been in the green for that to me is something to shout about, right? Is 1.2% enough? Probably not. But if we keep focused, and we keep obviously focusing on those 5 areas that I've mentioned at the bottom there, those are crucial to turning the business around. Repetitive lockdowns, everybody knows what that does. The stop-start in terms of getting your economy going, obviously affects confidence, the ability to export, and all the stuff that's happened in in the Durban Harbour and the Richards Bay port. I mean, that obviously has caused trouble, including the hacking of the system, or the failure of the IT system in the Durban Harbour, resulting in stock not being able to be removed from the ships or being able to export it. So that caused trouble. Reliable power supply that I mentioned, and then government infrastructure and spend, which obviously in all of those together could lead through to inflation with the increase in interest rate. Okay, does that make sense? So there's some positives, right? Those are the key drivers that we're looking at the moment. How long does lockdown happen? Can we get exports really up and going again? What does reliable power really look like? What the long-term effects of that? Government infrastructure is starting. Infrastructure spend is starting to look good. More tenders are being awarded, which is really positive to see. What is quite interesting is that the government has stopped awarding massive big tenders to single businesses. I think the likes of a Madupi and those kind of difficult situations have obviously brought some clarity there. But it seems to be good. So there's a lot of distribution of these infrastructure spends, which obviously creates unemployment and effectively, I suppose, shares quite a lot of the wealth. So I think that's quite positive. I'm eternally positive. If you ever wanted to speak to somebody about South Africa and whether we're okay, my door's always open. I firmly believe that we're okay. On paper, it doesn't look like that, and obviously it's a tough road ahead. But I still believe that South Africa is starting to make some of the right noises that should create a turning of an economy, although it is obviously quite a gradual one, right? In saying that, just because there's some positive things going on, it doesn't mean that assessing a trade credit risk is really easy, and obviously it doesn't mean that cover is freely available. So I hope that kind of makes sense. And as I mentioned, please, there we go. Please stop me at any time. Then the rights and trade credit insurance. I think this is quite important. Everybody knows by now that it's a SASRIA claim, and it's SASRIA and it's SASRIA, and that's what everybody's kind of saying. Well, don't worry, it's SASRIA. But what about the businesses that weren't covered by SASRIA? What about the businesses that are partially covered by SASRIA? I suspect that there are quite a lot of those. I haven't seen much about that. But what's really important for us, even if you are insured, what about the claim processing speed of SASRIA paying out? Okay, what happens between now and then? And that's where trade credit insurance becomes really interesting, because trade credit insurance is bad debts insurance, right? It's default cover. So we've got a client, well, not one, we've got quite a few clients in Durban that were affected by the riots, and their stores were absolutely vandalized and destroyed. And those were difficult conversations. And our approach to those clients, we phoned our Durban clients and we said, look, guys, how can we help at the end of the day? Because it matters for us, for our businesses and our insured risks, to get up and running as soon as possible. So it was very much a conversation about how can we help, right? If a business is waiting for a SASRIA payout, and they go under in the interim, well, then trade credit insurance is on the hook. Does that make sense? Because we cover default insurance. The fact that it related to a SASRIA claim may mean that we've got an avenue to recover against that insured debt or that bad debt. But in reality, it's not really a reason for us to be able to decline it. The trade credit policy, just to get a little bit technical, does have an exclusion that says, if you're able to get other insurance on that risk, then it's not covered under the trade credit insurance policy, which technically means that SASRIA is an other insurance, which means that we're not on the hook for the SASRIA event, and that's or for that writing event, which is 100% correct. We're not on the hook for that. However, if a business goes under because they're unable to trade, obviously we are on the hook. So at the end of the day, and linking to what Mabuti said in the beginning was, whether it's a cyclone or it's a fire or it's a flood, at the end of the day, if businesses can't trade, there's trade credit exposure. And that's what created all of the tension last year during COVID, and why the contraction of the economy is so important from a trade credit insurance perspective, Because if the stock isn't moving and the stock isn't being paid for, well, then, there's a trade credit claim there. So I hope that makes sense. And if any of your clients are affected by the Sasria claim or by the Sasria event and the right action, please get in touch. There are a number of interesting solutions that we can do through trade credit insurance to assist clients in getting out of trouble, as long as there's value, right? So the positive side from the right action, and even the positive side of COVID from our perspective, is that the businesses that failed during COVID and during the right action, or as a result of the right action, were not, the ones that were affected by it, right, because of lack of trading. It didn't mean that the businesses were bad. It just meant that they couldn't sell. Okay, but as soon as the business is back up and running, then the business is viable again. And I think that was quite important. So if the business was viable going into COVID or going into the right action, when we can get out of that, it'll be okay. Well, it'll be okay again if there's a business that's worth trading. That makes sense. But if there's a business that went into COVID in trouble, well, then COVID would have wiped them out, unfortunately. But it was a line in the sand that was created. It wasn't because I suppose it was because the business wasn't worth it, but it wasn't. It isn't a general negative to the businesses. So one of our clients in Natal, they're a liquor distribution house. They had enough equity to actually get themselves back up and running within a month. So they started trading a few weeks ago. And because they managed to get back up and running, they've managed to secure the distribution channels for a whole bunch of other brands that they didn't have before because their competition weren't able to get up and running. So there's a little bit of positives, but that kind of says there was a good business going into the right. They were decimated during the right, but managed to come out of it okay. And the risk and the trade credit risk from our side was still okay. So that makes sense. So it's quite important conversation. Trade credit insurance can turn insurance into cash. That's really crucial. You can cede your debtor's book that's insured to a bank. There are a number of avenues. You can discount your invoices that are insured to a bank or a finance house. So you can create cash in this interim while you're waiting for Sasria to pay out. So that's why I just wanted to mention that there are a lot of conversations that we can have to bolster your clients if they have been negatively impacted, so they're not just sitting around waiting. I'm not saying that they are doing that, but obviously that could be the case. Okay, so if there are any questions, I don't know if there have been, but I'm going to carry on if you don't mind. So what does trading on credit really mean? How do you assess a business that you trade with? This is not from my perspective. This is from when I engage with conversations with clients. And I say to them, guys, out of interest, what is your credit management program? What do you look at? The number one is, well, I know the guy. I've done business with them for 20 years. Not once have they ever, missed the payment. And that's great. And it's really important. And I believe in proven relationships as well. I think it is one of the number one reasons, but it can't be the only reason. And I use an analogy, which isn't great, but you haven't had an affair until you've had one, if that makes sense. Your client, your mate, who you've known for 20 years, hasn't missed a payment until he misses one. And in an instant where the economic conditions that I spoke about, where exports are tough but recovering because of the commodity prices, but trade is down, lockdown, sovereign downgrades, cost of money, all of those things are obviously impacting business. It's difficult to just say, well, looking back the last 20 years, we're fine, and therefore the next 20 years are going to be fine too. I think that's foolhardy. And one of the famous stats is that only one company, I think it's only one company that was on the American Stock Exchange is still alive and well after the 100 years. So it's a 100-year cycle, and there's only one out of the 100 that was there 100 years ago, something like that. And Kodak was the one that was number 2, and then it fell over. But that's quite important. So just because a business has a proven track record doesn't necessarily mean that that looking forward, that the proven track record will continue. Obviously, there's a comfort. Some of the other clients pull a bureau report. So that's when you pull, you subscribe to a TransUnion or an Experian or an XDS or an Oxico. Those are kind of, in our mind, probably the big three, big four now. Pull bureau information and see what they say. And that's quite useful because you get some trade information, you get some historical trade information, you get some bankers codes, you get kind of an overall picture, and they give you a scorecard, and that's pretty decent. I won't lie. I think that's certainly quite useful, and that is also one of the avenues that we look at. But is it enough to make a decision? I'm not really too sure if it is. The next component is an effective credit management process within your business. So it's not just about assessing the buyer, right? So assessing this proven relationship or assessing the bureau information. It's also about collecting the money, right? And it's about making sure that there's a relationship there on the other side of the sale, not the back side of the moon, that says, hi guys, have you paid? Will you be paying? When will you be paying? Do you have a dispute? So that kind of proactive credit management in the business to make sure that you're not only engaging with your clients at a sales stage, but you're also engaging with them at a collections basis. And what is quite tricky is that you normally have, the relationship side of the business is the one that obviously treats the customer like they're king, and then the credit manager is the one that says, why haven't you paid? And it's quite important that you have the same message across the board to your clients, right? That you're not just their friend when you're trying to get the sale, but you're also engaging with them, and there's a strong relationship coming back up the hill towards you. Right? It's a two-way street. And then obviously the last component is trade credit insurance, right? So that's where people just say, I don't really know what I'm doing here. I want to sell on credit, and let me speak to a trade credit insurer to see if I should be able to do that or not. Trade credit insurance is absolutely, it's obviously a meaningful solution, but I would say that it's not the end all and be all. There's a strong credit management process that needs to run alongside trade credit insurance. Trade credit insurers don't insure all of the risks that you have on your book. It's quite rare that we get to 100% of a debtor's book insured. And I'd even go so far as to say the only time where we get to 100% is where the client chooses not to trade with a debtor that we've declined. Does that make sense? So that means that's when they're following our process completely, and that obviously is fine and it makes sense. But at the end of the day, it hasn't developed any internal capability. You've outsourced your credit management process to somebody else. And that comes with a few positives. One, it comes with a better view on making risks, okay? Because we can see a broader spectrum. It's not just the risks that you see in your business. But what it doesn't have is it's an arm's length transaction, right? It's then Hollard engaging with the debtor. It's not you engaging with the debtor. So it's important to not lose sight of that relationship component just because you have trade credit insurance. So the ultimate solution is probably a hybrid of those four. And that, funny enough, is really what we look at. What also is quite important to understand is what the actual cost of trading on credit means, right? People often say, oh, yeah, we only trade on cash, and then they realize that nobody wants to buy on cash, so then they start trading on credit. But they just start trading on credit, right? And you even go so far as to say, if my price is 100 Rand on cash, I'll tell you what, I'll sell it to you at 100 Rand on credit. And if you pay sooner, I'll give you an early settlement discount of 2.5%, depending, what industry you're in, but that's generally the average one that I've seen. And are you saying, well, hang on a second, you did your whole costing model, okay, to get to a selling price of 10. Oh, sorry, a selling price of 100, right? That's not there by mistake. You chose your selling price for a real reason. Okay, now what you've done is you've either granted credit at that same price, or you've said, if you pay me sooner, I'm going to give you a 2.5% discount. What's important, that's fine to do that, but then you need to make sure that 100 has already catered for that 2.5% early settlement discount. So in other words, you should be selling it at 102 Rand 50, not at 100 Rand anymore. And similarly, the cost of credit, so that's what I said, that depends on the terms that you give your client. I mean, I think that makes sense. But it also talks about the terms that your supplier grants you. Okay, and I'm not going to get into technical things like days sales outstanding and things like that. But at the end of the day, if your client, so I'm trying to work out which way my camera is going to turn this from left to right. So I think I've got to be right to left. Let's try this. So I hope that's the left side. So you've got your supplier who's supplying you, okay, and they're giving you 30-day terms. Okay, so that means you're going to have to pay them back in 30 days' time. Okay, now you've got to give wrong way. I don't know how to do this. Anyway, you've got to give your client, no less than 30 days. No more than 30 days, because if you give them more than 30 days, that means they're going to, let's say, pay you in 60 days, but you had to pay your supplier 30 days ago, right? So that creates a 30-day cash flow hole for you. Okay, so you can't just determine that you're going to be selling on credit. It's not as easy as that. You need to understand what that cash flow shortfall means to you. If you have surplus cash available, well, then it's just the opportunity cost of not having that money in your bank account. If you've got to get an overdraft facility in order to manage that credit exposure, then you could be looking at 1%, maybe 2% a month, right? That it's costing you. So now we're back up to that 102 Rand, right? Because you've decided to sell on credit. And if you haven't included that 2 Rand, well, now you're short 2% in your net profit. Okay, and if your net profit is only at 10%, then now you're only at 8%. So that's a 20% drop in the profitability of your business. That's massive. Okay, so that's quite important, but you've got to understand what it means to trade on credit. If you want to trade on credit and insure it, well, now you're looking at that 2% plus 0.5%, let's say, because that's our average rate is at about 0.52%, just as a round number. So now you're back at that 2.5%. Okay, so now there's costs involved in this process. And it's really important to understand that, and not just look at trading on credit as a means to grow your revenue. And then the last component is that how do you manage the fallout? Right. So if you're not, if your processes are not robust enough to manage the fallout between you and your client, right, that can have catastrophic consequences on your business. The least of which is that they just don't pay you, right? And now you're out of pocket. You've given all the stuff away. Then you've got to go to court, and that costs money going to court. The problem with going to court is that you need a valid and binding credit agreement. So if your credit management process that I mentioned a little bit earlier isn't strong enough to stand up in court, now you're spending money to not win, right? So you've incurred costs, and you've lost money, and you've given your stock away. Right? That's what happens. And we have a lot of the times too. It's why the credit agreement is the cornerstone of our business. It's why we believe that governing the relationship between our client and their insured debtor is crucial in making sure that when it falls out, that there's a safety blanket there, and that there's a trampoline that can effectively bounce you back up to where you need to be. That's crucial, right? Everybody knows that insurance is about claims, right? That's when it matters. Insurance isn't about taking premiums, it's about claims. And how you manage the fallout is crucial. Because, again, you need to understand that is the fallout because there's a cash flow shortfall in your client's business, or are they going under? Okay, because the approach is different there. If they're going under, well, then you want to just get as much money as you can before everybody else in the queue is trying to get as much money as they can, right? And it's less about relationships, and it's more about recovering as much cash as you can out of the process. But if it's a short-term cash flow problem that your buyer has, it's important to have that conversation with them so that once they're through it, they still want to trade with you. Right? There's a lot of soft topics that happen there. And what's crucial is that your departure point should always be about about recurring sales. Yes, it's great to have one-off sales, but if I can manage the relationship to have a recurring sale, well, obviously that makes your sales job much easier. And it's crucial to have processes in place. And I'm going to go out on a limb here. Actually, this is not a part of a script. But if you've got clients who are trading on credit and they're just not sure if their credit agreement is okay, please get them to send us their credit agreement. No obligations. They don't have to insure it. They don't have to do anything. Just let us help them trade on credit safely. Okay, I don't mind. We can provide assistance. We can look at the credit agreements. We can provide ones that are acceptable, ones that stand up in court, ones that measure up to the Protection of Personal Information Act that's now obviously reared its horrible head, and things like the National Credit Act, which is quite important to not fall into, because it's trade credit. It doesn't fall into the ambit of the Credit Act. But it's important for us. So engage with us, talk to us. I think that's what's important. Is if we're not talking, nobody's learning, and policyholders, or clients, only have their world that they need to deal with. And what's important is that we have a far broader scope, less detail, obviously, because we will never understand their business as well as they do, but certainly a broader spectrum. And we often find a problematic buyer here, a problematic buyer there, and a problematic buyer there. Same buyer, but with 3 different suppliers, and none of them are aware because he's just bankrolling all of them. Right? He's 15 days late on each one of them, and nobody else really picks up, other than the fact that they just think that their finance guy is a bit lazy and he pays late. But actually what's happening is this guy, as soon as anybody pulls the plug, he's going under, and he's going to owe all 3 businesses the max value. That makes sense. So that's what I'm trying to get to is managing that process and assisting clients to get there. So get in touch and let's have conversations if they want. Okay, fraudulent business is a hot topic. In times where the economy is in trouble, I think fraudulent businesses pick up quite a lot. Actually, it's a hot topic at the moment. We're seeing quite a lot of fraud, and unfortunately, as with all things, I think the criminals are always smarter than the law. The law always needs to catch up with the criminals. And there are a number of different aspects of fraud or categories of fraud. And the 2 main ones that affect the trade credit space are scams and impersonations. Okay, so scams, as you can read there, is when a business really exists, okay, but it's all rubbish. It's all fake. So there is a 1, 2, 3, 4 shelf company trading as Willy Wonka. PTOL ticket. It's a real business. It's really registered. You can buy an aged business as well. So you can buy one that was registered in 1997, and now you've got a 14-year track, or what is it, 24-year track history. 24-year track history. And you can create fake credit agreements. You can create fake trade references. There's a lot of things that you can do in creating a scam. Okay, but it's just not the business that it says it is. So in other words, they said they've got R1 million in equity, but they don't have any equity. Right? That's a scam. If we don't pick that up in our underwriting process, which can happen, but the business is a real business, and this is quite crucial, then we would actually be on risk for that. And the reason why is because our policy responds in an undisputed indebtedness. Okay, so is the debt due? And if you took, I can't even remember what I called it, 1, 2, 3, 4 shelf company trading as Willy Wonka, and I take them to court, and those crooks don't appear in court because they're going to get arrested if they do, the judge is going to grant a judgment in favor of the policyholder or in favor of the seller because there was an absconding defendant, and we would pay because we've had a judgment, right? So it's one of our triggers. We have to pay that. Whether it was a scam or not is relevant. The fact that the debt is due is not a fault of our policyholders. Okay, where a scam, no, I'll leave that alone. And then impersonation is where somebody's pretending to be somebody else. Right? So I'm actually Gareth Joubert trading from my back spare room, but I've completed all the documents as if I'm Anglo Gold, right? So I pretend like I'm Anglo Gold. I've stolen the registration numbers. I've managed to procure their CK docs. I've managed to procure all of that stuff. Okay, so I'm pretending to be Anglo Gold. And often what happens there is a little bit of something to look at. Oftentimes those people will collect. You don't deliver, you collect. And the reason why that is because if you had to deliver, you deliver to Anglo Gold, and the security of the procurement office at Anglo Gold would say, we didn't buy this stuff. And if you are doing business with Anglo Gold and they're asking you to deliver to a different address, well, then it's important to make sure that that different address is in fact also Anglo Gold's address. Google Maps search, just is it an empty felt? This has happened too. These are real stories. Right, so that's something that you can do to measure that. Most of the time, like I said, they'll collect, because they don't need you to know that they're not Anglo Gold. You'll often also meet in a restaurant if you ever had an in-person meeting on that basis. Impersonation is not covered under trade credit insurance. This is crucial, and the reason why it's not covered is because it's based on an undisputed indebtedness, and we're on the hook for Anglo Gold's debt. Right? That's what we've underwritten. We've underwritten Anglo Gold, and we've confirmed cover on Anglo Gold. If you've sold to somebody who's not Anglo Gold, well then Anglo Gold's never going to accept that debt. You can take them to court, and they're going to defend that matter because it wasn't them. So that's not covered under the trade credit insurance policy. And there are, like I said, interesting tidbits, let's say, to figure out, if or fraud flags, let's say. And I'm not going to go into all of those because that'll take about 7 hours. But if you're ever interested in that conversation, I'm very happy to obviously chat to you about that. But those are the two big ones. Okay. Scams would still be covered, right? Because it's a real business, and our job is actually to make sure that we pick up those scams. And we look at things. I've mentioned some of them already, but if a guy's got a Gmail account, 10 to 1, that's a flag. Does a flag mean that it's definitely fraud? Absolutely not. It's also quite exciting and not really anything to mention yet because it's not off the ground. But the trade credit insurers are engaging with the SAICB, with Garth de Klerk, and we're busy trying to see what a fraud database in the trade credit space looks like. Okay, so fraud is obviously includes these scams, impersonations. Would also include things like financial accountants who are producing fraudulent financials. I mean, you can't believe the stuff that we get and the stuff that we get repeatedly. It's actually amazing. And in fact, the first, call it dubious matter that we ever had, it's a long story. Basically, the guy pretended that he got shot with 7 million rand in his boot. It was a hell of a story. But he's reared his head again. No, and that was back in 2017. And we got a credit application with the same guy. Now, new business, new everything, new numbers, obviously, and there he is again, rearing his head. So the good news is we managed to pick that up, and it was an easy decline for us. But everybody else that's dealing with him isn't aware of his history, right? And they aren't aware of that. And if he's smart enough, you only find out when he's fled the scene, so to speak. So that's quite an important topic to my mind, and it's about conversation. You don't realize how important information is until it's too late, I suppose. Okay, I'm reaching. I think I'll flow through this a bit. Mums, I hope that's okay. But like I said, I'd rather have more questions and more conversations than me talking. But I thought it would be quite interesting for me to just go through what we look at when we underwrite a risk. Okay, so I've spoken about, obviously, the economy. I've spoken about how a client can manage their risks or assess their credit risks. Kind of the difference between scams, the different types of frauds. And then it's what do we look at, okay, when we assess a risk? So we try and gain, as in-depth knowledge of the buyer as possible, right? So that's the business as a standalone business. So who is this business? Does it wash its face, right? Is it worthwhile? Is it a business that I'd like to get in touch with? is it something that I think has got a trading history? Obviously, I'm not a futurist, and I can't determine if some yo-yos are going to be the next best thing. I mean, that's not what I'm about. I'm about assessing if the business can stand on its feet, and importantly, can the business survive X number of months to prove the track record, right? So new businesses are obviously much harder to assess than that, but businesses that are going concerns, you can look at a business and go, are they going under in the next 6 months or not? And you can often tell based on the activity of the business and based on the financials if they're okay in the long term, right? Or in the medium term. And where they're not, well, that's what trade credit insurance is for, right? It's not meant to cover, you as the business is descending down into the depths of despair. It's actually there for, for things like a COVID, or things like, if there's an explosion and that sector gets wiped out. Trade credit is there to prevent that, right? Does that make sense? So it looks a lot like wear and tear insurance because you manage your business and you look at the exposures as they go down or as they go up. So it looks a lot like wear and tear, but actually the emphasis on the product is about kind of total losses when the business is wiped out. Anyway, so we look at the business as a standalone. We look at the people in the business. Okay, so the individuals in the business. So who are the principals in the business? What are they doing there? What other businesses are they involved with? What is their track record? I met with a client last week, and we were engaging, and they've got a few businesses in their group. We look at one of their businesses. Another one of their businesses has had some tough times. And they just said to me, "What should I do here?" One of the suppliers is actually trying to get them to liquidate, and they want them to give their client base to their supplier. So, I mean, I can understand why the supplier is trying to do that. And my advice to them was, look, you just got to make sure that you make the right decision. But you've got to understand that if you liquidate your business, yes, it ends the drama for that business. But what it also does is when I look at your credit profile as an individual, I'm going to see that you started this other business. It's only 18 months ago, and now you've liquidated it. So that tells me that you're not afraid to liquidate the business within 18 months, okay, of starting it up. How do I know that that's not how you're going to operate in your current business, not the one that we're looking at? Right? So that's why we look at individuals. Do they have a track record of registration and deregistration? Do they have a track record of buying and selling? Do they have a track record of not paying their bills? I mean, that's obviously crucial to this environment. And then the third avenue on knowing your buyers is, are they part of a group? Are they part of a buying company? Are they part of a hold company? Are they part of distribution channels? Is there a vertical integration, where the supplier, the client, and the buyer effectively is on the same chain with the same ownership? Those kinds of things we look at because it's important to understand what happens when things go wrong. We had a claim, I can't remember when it was, maybe about 2017-ish, where we had the subsidiary of it was a holding company, and then there were a whole bunch of subsidiaries, and we were on for one of those subsidiaries. That subsidiary was fine, absolutely fine, no problems there at all. But what ended up happening is one of the other sister companies went into trouble, which created the holding company to go into trouble, and the holding company then extracted value from wherever it could into the holding company to try and keep the holding company alive. And at the end of the day, all of the businesses underneath them went into business rescue and ultimately liquidation. So that's quite important, right? You need to know, how does the money flow uphill? How do the directors or the members of the business, remove value? What is their dividend structure, loan structures, things like that. So that's quite important when you look at it. So the business as a standalone, the group, what is the impact on the group, and obviously the individuals of the business. Right? So those are things that we look at from a trade reference perspective. And this often talks to that relationship component that I mentioned earlier, which says, well, I know the guy, and that's important. Right? I would like to know that any single one of my debtors that I insure, right, for our policyholders. That if they had 10 Rand left, they would give it to my policyholder. Right? That's obviously what I'd love to hear, because that means that at the end of the day, the last Rand is going to come our way, which puts us in a better position. In reality, obviously, it doesn't really work like that. But there are key dependency issues, and you certainly can find yourself on the better end of that payment cycle. And it's crucial, again, to understand that. So when your client is looking to sell on credit, who they're selling to and how important are you to them? Can they buy what you're selling from somewhere else? And if they can, well, then you really need to be comfortable with that relationship that you have. When we look at trade references, we want to make sure that they're relevant, right? That they're relative, that they're credible. Okay, so credible. I'll get into that last. Relevant is if I'm selling steel, and I get a trade reference from your vet, right? Because of your dogs. I mean, that's not relevant, right? I'm trying to sell steel here. The fact that I pay my vet bills is not a valid, or the fact that you pay your vet bills is not a valid or a relevant trade reference. Yes, it's a positive trade reference, but it's not relevant to what you're trying to do, or what business that you're in. So it's important to make sure that you have relevant trade references. Okay, relative is about size, right? The quantum of the risk. So you want to issue R1 million or 100 million Rand worth of credit sales to your client, and they give you trade references for 25,000 Rand from their Walton stationery account, as an example. I mean, 25,000 Rand is not really relevant to the R1 million or the 100 million Rand, right? It's just because you can pay 25,000 Rand has no bearing on the fact that you're going to be able to pay $1 million or 100 million, obviously, as a ridiculous example. So that's really important, right? So is it in line, right, with almost that supply chain? Does it have merit? And then does the size make sense? So can you actually handle that value? And then the third component, which is something that's quite interesting, and it's something that I personally struggle with quite a lot. And it happens in, I'm going to call it consolidated markets. Okay, so big industries where there's already quite a mature setup, and there's only kind of 3 players left. As an example, 3 major players. Obviously, there's little businesses around there, but there are 3 major players left. And what happens there, funny enough, is and I've got to be so careful not to use names here. You have this supplier, okay, on this buyer, and then you have another supplier on that same buyer. Right? If my client, I'm busy assessing for my client, right, and I'll phone. Now it's got to be relevant, right? So I've got to phone my client's opposition effectively for a trade reference, right? And what's important to understand is that my client's opposition is oftentimes inclined to give a good trade reference when it's a client that they're trying to get rid of, okay? Because if they give me a good trade reference, I'll grant the cover, and that client will buy, that debtor will start buying from my client. And conversely, if it's a client they want to keep, they'll give a bad trade reference so that we don't grant the cover so that the client stays with them. And that is a really tricky line to understand, is how do you sift through the trade references to make sure that they're credible? Okay, so not only do they have to be relevant and relative, but they also need to be credible. And that's an unfortunate part of the world, I suppose, that you're never too sure what you're dealing with. And it's quite important to be able to interpret that. And we've got a bank of researchers that's all they do. They phone for trade reference. Not to say that's all they do, as if it diminishes what they do. It's their core focus. They phone people for trade references, and they know what to listen out for. And the key words that seem to come up when it's a kind of call it a fake trade reference, so to speak, or a not 100% honest trade reference. The next thing that we look at is bankers code. So bankers code is you can go to the bank saying, I need to know if R1 million normally flows through this bank account, or is that normal, for this course of business, and the result ranges from A to H. A being undoubted, C being good if quoted strictly in the case of business. That's kind of where most of them are, most of the good ones are, and then D above starts going more kind of, I suppose, E-ish, where it becomes partially dishonored, frequently dishonored, and that just says that you shouldn't, effectively these guys struggle to make payments at that value on that credit circle. So that's a really important measure, not necessarily to grant cover, but certainly to decline cover, right? So it's one to say, if the bank's saying he can't pay, then there's a good chance that he can't pay. With the implementation of POPI, bank codes are pretty much are becoming a thing of the past, or at least they're going to change shape. But quite a few of the banks have said that they're not doing bankers' codes anymore because of the fear of transgressing with the POPI Act. And we're moving along our underwriting processes to obviously not rely on the bankers' codes, but hopefully the banks are going to come up with something else that'll assist us getting that insight, because it really is some valuable insights. The banks are fortunate that the bank can ask for any set of information or any security, and everybody's happy to give it to the bank. But if we have to ask for certain things, then obviously it's well, we're just an insurance company. We don't need your financials. Can't you just give me 100? Oh, not 100. That's a lot. 10 million rands worth of cover without knowing anything. That's a request that we get quite often. And then the last two components, which are a little bit meaty, is obviously the financial position of the business. So what do we look at there? And then a buyer's visit, I think, is a really nice way to assess your risks. So when we look at the financials of the business, we look at obviously the income statements and the balance sheet. We look at the other statements as well. But for this conversation, I just wanted to mention these two, and it's important. It's important to look at them and to understand what we're looking at when we're looking at them. Obviously, this is not all inclusive, and there are a lot of other measures that we look at, but I didn't want to bore you with accounting detail. And I hope this isn't considered accounting detail. But at the end of the day, are they making money? Right? Do they make a net profit? Right? And do they make a gross profit? And if they make a gross profit but a net loss, well, why? Okay, so what happened between them buying a product, adapting it or manipulating it or creating value in the product, and then selling it, right? So why did they not make a net profit? Right? So coming out of COVID is a really good example. They could have a gross profit because they only bought this much, I'm going to just use names, flat steel, and then they adapted the flat steel in their factory. So that at that stage, they're positive, right? Because they bought the steel and they've worked on it. But then because of COVID, they weren't able to really generate the sales. But that's fine, because my cost of sales were down. That's why my gross profit is up. But they still had to pay for all their overheads, all of their staff, because they didn't want to retrench people, right? So now that's why they've made a net loss. So the business is okay, but it's quite fat at the OPEX. And they're saying, well, why is it fat at the OPEX? And that's the important thing, is ask the questions, look at them. And if I could give anybody some advice, especially when it comes to like accounting and financial statements, just ask questions. Ask as many questions as you want. Most people don't know what they're talking about when it comes to finance. I don't even understand, to be honest. Sometimes, and customers are always very happy to take you on the conversation, right? When you're looking at financials, to understand if there's any value there. And it's quite surprising. Maybe it's because we're an independent party and they're quite open to it, but it is quite interesting that people love talking about their businesses, right? And you need to harness that. You need to have that conversation. Right? The next important thing, EBITDA. Right? EBITDA is a word that you hear all the time, especially with listed businesses. EBITDA. But what is EBITDA? Right? It just sounds like a fancy way of saying net profit, and or kind of it's almost like a gross net profit. And it kind of is that. But if you look at what the EBITDA stands for, right? So EB is earnings before, okay, interest, taxes, depreciation, and amortization, right? So what's important is that if your EBITDA is positive, right? That's good, right? That means you're making money, right? You're earning money. But if your net, you're making a net loss after, interest, as an example, that tells me that the funding that you've raised to finance your business is costing you more than you're able to make, which means the business isn't okay. Does that make sense? So it's important to understand those kind of aspects. I'm not going to go into the rest of them, but it's important to just ask questions, understand the levers and the triggers behind that. When we look at the balance sheet, am I running out of time, Mums? Oh, I've got to 11:30, eh?
Unfortunately, only until 11, but that just means we need a part 2, Gareth.
No. So this is it's pretty much the second last slide.
No, not a problem. I'm sorry. If anyone does have to drop off the call, I've just put your email address in the chat box just so that we can engage offline. But if you could oblige us just for a couple of more minutes while Gareth wraps up, that would be great. But yeah, if you do have to drop off, please do. The session is meant to finish at 11. So thanks so much. We have noted your questions as well.
Sorry, Mum.
No
problems. At 12:30. I apologize, guys.
That's okay. We'll have to have a part 2 so you can go in even more in depth.
Okay, cool. So what do you want me to do? Do you want me to carry on or close up?
Do you have maybe a couple of like wrap up points?
Yeah, I've got like three minutes. Okay, so balance sheet. What's important there is it's about, are they okay in the short term, right? So their current assets minus their current liabilities. How much money is coming into the business, assets, or in the business? How much money do you owe, right? Liabilities. Is it okay? Do you have enough cash coming into the business to fund it in the short term? Really important. And then again, in the long term, total assets versus total liabilities. So total money coming in versus total money going out effectively. Are we okay in the long run? So that's really crucial when understanding a business from an equity perspective. Obviously, if equity is the value, so equity is the sum of all your net profits since you started your business. Obviously, the bigger that number is, the more comfortable that number is. But effectively, that tells you, the equity tells you how much money the owners have left in the business to carry them through a bad time. Right? So that's a really important number. I'm not going to really go into this, but it's important to look at comparative numbers. Okay, so look at last year to this year to understand the trend. Use management accounts to bring you up to date. If your financial year end was December 2020, there's been 9 months or 8 and a bit months since then, right? So what's happened since then? So ask for the management accounts. The trickiness with management accounts is that they often, don't really tie to the real financials because they haven't taken provisions or non-cash items into account. So just look at them with your eyes open. Ask questions. We sign non-disclosure agreements whenever required to obtain financials. So if you ever have a client that doesn't want to give financials, we do, swear ourselves to secrecy. So the client should be okay with that, and they generally are. And then the last slide, Mums, is on buyer's visits. They are so important. If you can go visit your client and go kick the tires, go do it. It's crucial. Sit down with them. Arrive early. It's one of the best tips that I've ever had. Arrive 30 minutes early for a meeting at your client and just sit in the reception and listen to the activity. If there's no activity, get back in your car and go home. If there's a hive of activity and the business is pumping, well, then obviously you want to start pushing your sales there, right? Ask questions. Ask them to take you a walk around their shop. They are so proud of their business. They'll always want to take you around. And does what they say stack up? Their financials say they've got 100 million rands of the steel. Can you see it? Can you see it on their shop floor? So it's really useful, I think at least, information, but it's crucial. Ask questions. If I could, we would want to do a buyer's visit at every single one of our clients. It's just too expensive for us, right? Because we only earn a percentage of a percentage, right? So we don't really earn much of that. But obviously you as a sales generator, let's say for the business, are able to cover that cost of the buyer's visit. And in fact, what's not a bad idea, I've just thought of now, is we can give you a buyer's visit template. These are the questions that we look at and we ask for. Some of them you might not understand, some of them you will understand. But that can be a part of the solution, that we use to underwrite a file. I mean, that could help us go a hell of a long way. And apologies for the rush at the end there, because the buyer's visit is really the most exciting part. But please, if anybody's got any questions or comments, please get in touch. Here are the details. Trade credit at hollard.co.za is the email account that everybody has got access to. And I'd even request that you make sure that even if you email me, you copy that in case I'm in a meeting and obviously miss the query.